gold has become the de facto asset, the de facto alternative to the US dollar. That's not just a function of short-term diversification trends. That's a structural shift in this environment that's, dare I say, undervalued. Commodities as a whole. And so people are now asking which is the next metal to go. And
it seems that the commodities are currently in a super cycle, as some analysts and economists would describe it. And the question that investors have on their minds is, at what point in this super cycle does it start to top? Are we at that point yet, or is there a lot more room to climb? What is the future of gold, silver, copper? And we'll talk about palladium and platinum today as well. And what is the future of tech stocks? Is there a rotation happening? Will Rhind is the CEO of GraniteShares, and he has ETFs in all of those sectors and assets, so he's well positioned to be talking to us about these particular trades. And he's a 20-year veteran in the ETF industry, previously serving as CEO of the Spider Gold Trust. Welcome back to the show, Will.
Thank you, David. Thanks for having me back.
Yeah, it's been a while since we caught up. A lot has happened. Let's just start with the obvious question. How far is this gold and silver run going to go? Right now, as we're speaking today on the 22nd of January, gold is currently at $4,896, almost at $4,900. And it's moved up so quickly in such a short period of time. I think people, especially in media, people like me have become so desensitized to say every single day we're at a new all-time high. But yet here we are again. And silver's almost at $100. So almost at $5,000 and almost at $100. These are prices that I didn't think I would be saying this early in my career, maybe in 5-7 years down the line. And I think you and I have been talking about this for years, since 2020. We were both speculating when gold would hit 5,000, when silver would hit triple digits. And here we are in 2026. What's your reaction to these prices happening far sooner than what you told me would happen a couple years ago?
Yeah, and I think I'd add to it that you're seeing this in an environment which is also atypical for gold, where you have a high in gold, but you also have a high in stocks. And typically, in past cycles, you've seen a high in gold, but stocks dislocated from that price sort of considerably. So from that perspective, when you look at some of the valuation metrics that people point to when they evaluate the gold market, such as the Dow Gold ratio or S&P Gold or world equities to gold, it still appears like gold is undervalued based upon those metrics, because equities themselves are so high. So from that perspective, if you're looking just at a ratio like that, then gold could indeed go quite a lot further. I think the important thing I would just say here is, like, to take a step back. What's going on? Gold has become the de facto asset, the de facto alternative to the US dollar. And I think that's not just a function of, hedging, of, short-term diversification trends or anything in the market. That's a structural shift. And, the world is changing and gold prices are reflecting that. So we already saw officially gold surpassed the euro in terms of official reserves held outside or in addition to the dollar. But I think it's more reflecting this de-dollarization sort of trend, this structural shift from a globalized world to a deglobalized world, and gold taking more of a central role in that.
Well, I'll just get straight to it. How far is this gold rally going to go? We're at 4,800, 4,900 almost. What's the top for you?
I don't know. I wish I knew. I wish I had a crystal ball and could predict where this rally is going to go for gold. But my sense is that people are under allocated to gold still on a global basis. The gold share of the global asset allocation pie is still very, very small. And from that perspective, more people allocating to gold, I think you could see a gold price much higher.
And what is silver's narrative right now? Why is silver almost at $100?
I think it's a very similar thing, David, that, we live in a world where if gold prices are rising, you'd expect silver prices to rise alongside gold, maybe higher than gold, given that silver is more volatile than gold. So silver sometimes, or has been known as a leveraged play on gold. And I think it was odd to some degree that we were sitting in this environment where gold prices continue to break out, over multi-years, and we didn't really see the same reaction from silver. That all changed last year. Silver really broke out last time. So in some degrees, it was playing catch up to gold. But I think a similar story. On the one hand, people are looking for metals, something that are not traditional stocks, not bonds, live outside of the financial system, something that are not correlated to traditional assets. And gold, to the same degree, or same as silver and other metals we'll talk about, have been suffering from the same issues of underinvestment for many years, deficits in some cases, and all of that has led to these demand shocks that we're seeing.
And it's not just Main Street investors. Wall Street is also incredibly bullish on the precious metals. So this came in from CNBC. Gold breaks new record, 7,000 on the horizon. Julia Du, senior commodity strategist at ICBC Standard Bank, sees gold pushing as high as 7,150. Analysts surveyed by the LBMA expect gold prices to rise above $5,000 this year. Even Goldman Sachs has reiterated his bullish stance, calling gold its highest conviction trade. When you see Wall Street this crowded towards the bull stance, first of all, when was the last time you saw this sentiment on Wall Street? And second, does that usually portray a contrarian indicator such that perhaps the top is in?
It's a great question, David, because in previous cycles, I feel like when we have gotten close to highs, there's been that mania that you traditionally associate with bubbles. And indeed, every talking head on a CNBC or major news publications would be talking about gold in a bubble. And that would be the headline. Guests that would be invited on the show be the first question they would ask. I haven't seen that this time around. So although we're starting to see, bullish comment like the ones you just showed on the market, I don't think we're at the mania phase yet, where everybody is sort of unanimously announcing that gold will kind of go on from here. So I don't think we're there yet, but certainly those are signs that people are starting to become aware.
Before we continue with the video, let's talk about today's sponsor, Monetary Metals. You already know why people hold gold, because it's real money. But what if your gold could do more than just sit in a vault? Well, that's where Monetary Metals comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your gold works for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar does. Thousands of clients already earn a monthly yield in gold through Monetary Metals, so don't just hold it, put it to work. Go to monetary-metals.com/Lynn, link down below, or scan the QR code here to learn more and start earning real gold on your gold today. Okay, let's take a look at gold versus the S&P 500. In fact, I'm going to actually put this on a percentage scale, and I just want to compare the two asset classes together. Over the past 5 years, gold has climbed 167%, beating the S&P's 80%. Over the past 1 year, huge outperformance, 80% over the S&P's 13.5%. And if you just scroll all the way back to, I guess, the last 10 years, well, then you could just start seeing the stock market outperforming. But it's really in the last couple of years that gold has not only caught up, but started beating the large cap stocks. Is there a fundamental shift in global asset allocation that's making this possible, Will?
I think there is. And again, it goes back to what I was saying about gold becoming, I think, the de facto asset alternative to the US dollar. So meaning that gold's importance in global portfolios is increasing. Its importance as a reserve asset. We know central banks have been buying gold for the last decade and continue to do so. So I think that that's in part reflected in terms of what's actually happening, but it's also reflected in terms of the changing, geopolitical system and the world order, where we're moving to a much more polarized world. And from that perspective, assets, safe haven assets of the highest quality like gold, I think are having or playing a more important role.
It certainly is a little bit odd to me because usually in an environment where people are protecting against what you may call a break in the hegemonic world or a more polarized world, or even just a break away from US dollar denominated assets, you would expect stock markets to kind of reflect those worries. But like you pointed out in the beginning of the interview, both stocks and gold are simultaneously hitting all-time highs. And so why is it that gold isn't technically behaving like a risk-off play right now? Because there's no risk-off sentiment that I'm observing. Well, it's actually performing like a high, huge beta risk-on play to global risk-on sentiment. What's going on?
Well, I think that the one thing historically that we've always known about gold is it tends to anticipate as opposed to react. And so part of the reason for holding gold in the portfolio over the long term is that it tends to anticipate, potential shocks as opposed to be an instrument that just solely reacts. And so from that perspective, you have stocks at all-time highs. You have, at least as far as the US is concerned, you actually have good, fundamental dynamics. The economy seems to be, from that perspective, there's an argument to say that there isn't much risk-off sentiment. And indeed, things such as, at least over Davos over the last few days, the machinations over Greenland, etc., there seem to be more sort of bark than bite, which do get reflected to some degree short term into the gold price, but I think not longer term. I think what's really going on, in addition to that, David, is that we're talking about the anticipatory nature of gold. We know that one of the main reasons gold has been reacting in the way it has is because the dollar's been weakening. Well, the dollar's been weakening because the Federal Reserve is on a rate cutting cycle. But more importantly, I think people look at the amount of debt in the US, they look at the amount of debt held by governments around the world and see that, governments are easing, so interest rates are coming down. And all things being equal, what that means is that the victims really are going to be the currencies. And so if the value of paper currencies are going to be eroded, then people are looking to defend against those paper currencies eroded. And that's why, again, gold is becoming so important.
If I had missed the run in gold and silver, and I stay on the sidelines, I have a few choices. Either stay on the sidelines again, still, and wait for a correction, buy gold or silver now, or rotate into something else. Which option do you think I should consider? I mean, or at least what are the questions I should be asking myself in order to make a decision like that?
Well, I think the one that we haven't talked about, which we get probably the most amount of interest in at the moment from clients, is platinum. And so, for those that are in gold, chances are that you're probably in gold. You've been in gold for a long time. Silver to a lesser degree, perhaps, but at least the move in silver has been very, very strong and very quick. And so people are now asking which is the next metal to go. And platinum is certainly, I think, in the contention or in the mix there, because it's not something that perhaps most people would have on their investment radar, but it's a market that's a lot smaller than gold and silver. It's about 30 times rarer than gold. So it is a market that, again, similar to the dynamics we've seen in other metals markets, has been underinvested in for years, leading to a current deficit situation, vulnerable to demand shocks like we're seeing. But it's a metal that's used in green technologies, everything from medical devices to hydrogen technology and automotives. And so from that perspective, platinum used to trade at a premium to gold for the longest time. And it was such a kind of well-established relationship that the word platinum in the English language became synonymous with meaning above gold. So a platinum credit card was better than a gold credit card, etc. And obviously, if you look at that today, if platinum was to retake premium to gold, you'd be talking at a price, roughly speaking, double where we are today. So if you're looking at it from that perspective, then platinum still has a lot of road to go before it catches up to where the gold price is at the moment.
It's already outperformed gold by a lot in the last year. And if you look at the last 5 years, pretty much flat until a huge breakout in the middle of 2025. What happened in the middle of 2025, Will?
I think similar to what we were talking about regarding silver, I think people started to wake up to the idea that, gold was ripping. This was a new environment. There was a bid for precious metals, for hard assets in this new changing world. And, these metals, which had been sort of languishing for many, many years, had good fundamentals, but just needed that demand spark or that demand shock. And so people rushed into silver. Silver started to rally. And then platinum, a similar thing. And I think that's really just starting for the platinum market.
Palladium as well. And I remember a few years
Palladium
ago.
As well.
Yeah, I remember a few years ago, the PGM metals were, they were seen as becoming out of favor. Perhaps that explained the price consolidation in the last couple of years. Well,
oversupply, out of favor, no great demand sources or catalysts. And of course, all of that's changed.
The electric car narrative really drove home the possibility that these PGMs would no longer be needed as they're commonly used in catalytic converters for ICE vehicles. And so that fear kind of put demand on the back burner. I don't know if the fact that palladium and platinum are skyrocketing now signals a shift in the EV, the future of EVs, and whether or not that will still become a dominant theme in the auto industry. What do you think?
Oh, 100%, David. I mean, there's a huge factor behind it is that, like a lot of things in life, I mean, people tend to overreact to everything. And, a massive overreaction to EVs was, of course, that we'd no longer have ICE or internal combustion engine vehicles, and they'd all be thrown by the wayside. And it was just a winner takes all sort of situation. Of course, things are never that easy, never that simple. And you look at the struggles that Tesla's had and the other EV manufacturers have had as well in terms of demand. And you see that narrative is starting to stutter. Now, it doesn't mean that electric vehicles are going away. It just means that I think the electric vehicle trend will be slower, broadly speaking, to catch on. It won't perhaps reach the market share that people talked about a few years ago. And all that means is that, existing manufacturers, and we've seen some of the big US ones, the Fords, the GMs, et cetera, will continue to focus on ICE vehicles. And perhaps the one thing that benefits platinum and palladium is that emission standards are probably not going to go away and won't be relaxed. And so we're still going to have ICE vehicles. They're going to be on the road for longer than we thought probably a few years ago. And we need platinum and palladium. Why
is it that copper is also at all-time highs? And it seems like every single commodity we were talking about, except oil, by the way, just the hard metals, just hitting all-time highs. I'm a little bit concerned about inflation. Gold aside, which could be seen as a monetary asset, silver, copper, platinum, palladium all have industrial use cases. And if so the input costs go up, slowly but surely it's going to trickle down into everything else that we consume, which is basically everything that uses all electronics that use copper and silver and heavy industries that use palladium and platinum. What's your take on what copper is doing and what it's signaling for the economy?
Yeah, I mean, similar thing to what we've discussed, albeit the key thing for copper is the demand for AI and general electrification of everything. And so that's reflected in demand for electronics, demand for electrification in the economy. And then now, obviously, the latest thing is demand for AI, where we need way more power than we have, building out data centers, everything else, way more copper than we have. But the fundamentals are still the same, which is it's an industry that has had, a lack of investment for a number of years and has met now a demand shock whereby, people are looking for metal. And, you can't just manufacture more overnight to meet that demand. And that's why commodities are cyclical. We're in a crunch part of the cycle where we now see favorable supply-demand dynamics, and that's been reflected in the price. But put simply, copper is a strategic metal that we need for all these key things that we're talking about in the economy. And right now, that's a crunch for that particular commodity.
Let's move on to some other assets, but more broadly, GraniteShares has ETFs in a wide range of industries and asset classes, ranging from precious metals to commodities to tech stocks. And we're in an environment that where everything's gone up. Like we talked about earlier, stocks have gone up. Commodities have gone up. So congratulations, by the way. Your clients must be very happy. But your clients a new prospective client were to come to you, well, and says, well, in an environment where everything in your offering has pretty much gone up, how do I allocate my assets? Where do I go? What do I do when everything's just booming? I can't buy everything. Well, I suppose I could, but then again, if I do that, why don't I just buy a mutual fund? So how do I, what's the decision-making process I have to go through as an investor in order to allocate my assets properly in an environment like this?
I mean, look, there's a number of ways to answer the question, but fundamentally it's about your time horizon in terms of how long your investment horizon is and your attitude to risk. I think there's kind of two key variables. And then it then comes down to what do you personally believe? What kind of environment we're in, what things excite you, what things terrify you. And that kind of leads you to a style of investing where you might be massively into the future and therefore be a big AI proponent, lead you to tech stocks, etc., believing in the future. Or you might take the opposite view that it's a bubble and therefore you want to be as defensive as possible, leading you to assets such as gold, silver, or other mechanisms such as just income producing funds. And so it really depends on who you are as an investor and what you're looking to achieve.
Before we get to your outlook on tech, let's just take a look at your offerings here for tech stocks. You've got long and short ETFs. So which have been more popular in terms of trading volume, the long ETFs or the short ETFs? And these
definitely
are
long.
Okay.
Definitely long, given the market's at highs and given we're definitely skewed towards buying. I'd say long, and the two biggest themes would be AI and crypto. So crypto come off the boil a little bit over the last couple of months, but still, very interesting to people. But those are the two, I think, the biggest, most interesting, most popular themes that we have.
Well, it's not just come off a little bit, Will. I mean, you've got an MSTR ETF, for example, long and short. And I'll just go to the strategy. I mean, great company, but they've had a rough year. 2025 has not been kind to them. They're down about 60-70%. And that reflects broadly the waning sentiment in cryptos overall, especially Bitcoin. What happened? Why are we seeing a breakout in pretty much everything we've discussed so far, including stocks, including AI stocks, including tech stocks? But then Bitcoin and crypto companies, which traditionally have led the bull rally when there is a bull rally in other things, that hasn't happened in the last year. Why not?
I'm not a crypto expert, David, as you know, so I don't really have a great answer for this other than to say I think part of the rationale in terms of the Bitcoin price in particular has been that there were still a small number of holders who held a huge amount of the Bitcoin assets. And I think $100,000 was a psychological level for some people who had been in it for a long time. And there was a lot of selling around that level. And so the argument, the bulls would say, well, that's a healthy correction, healthy consolidation, etc. And the bears, I think, were looking at it more as being, look, some of the original people that held huge amounts of Bitcoin are getting out. Maybe that's a sign that the market is topping. And so I think there's a bit of a push and pull around this level. And we've seen the prices, go down to the high 80s, and then now in the 90s. So, it hasn't completely sold off, but it does look like we're in a bit of a, bear market for Bitcoin at the moment.
have you talked to some of your clients or associates about what they're interested in? So someone's browsing around in GraniteShares over the last year. Have you noticed a shift in sentiment and what people have been asking you about more or more interested in?
Definitely. I think there's been, I'd say that the two things, because you could say that growth is permanent to some degree until there's a correction or until there's, a crash or something, and then you get a shift in sentiment. But I think the most part, people are growth orientated. And I think the twist or the difference that we've seen is more people saying, I want to prioritize income, or I want to prioritize metals, like more defensive assets or commodities. So I want to diversify away, or I want to switch out some of my growth and focus on just income production. I think those are probably the two things that we see most at the moment.
Okay. How does income generation work in your case? Tell us about some of these income generating ETFs.
Yeah, I mean, you've got different flavors of income generation, from the, let's call it, more conservative income generating funds to the much more aggressive income generating. So on the aggressive side, our yield boost ETFs generate income through option strategies. So executing options to generate high levels of income. HIPS, the one you're looking at now, that's a more conservative portfolio, owns a diversified, equally weighted portfolio of pass-through securities. So things like MLPs, which are typically energy infrastructure assets, REITs, closed-end funds, and BDCs, or business development companies. So that one it's about 10, 11% per annum, pays monthly, pays a 10.75 cent per share distribution every month.
What would be some of the risks to the underlying
the underlying assets?
Yeah, the underlying assets and just the par value here.
Yeah, so a good example was the performance of the portfolio last year was not that great. And the two reasons why, or the two sectors that underperformed, were MLPs, which are oil and gas infrastructure assets, so pipelines typically. Why? Because, as you said, the oil price went down. And so energy-linked assets didn't do well last year. BDCs are another area of the market that, while BDCs, the BDCs that we own in the portfolio were obviously fine, the BDC market was clouded by a lot of panic over private credit. So while BDCs are publicly traded, they are linked to the private credit asset class. And there was a lot of panic in there when First Brands and a few other frauds were discovered that caused some big write-offs within the private credit space. That affected negatively the BDC population. So you had two parts of the portfolio negatively affected, and then positive performance from the closed-end fund part of the portfolio and from REITs.
All right. Well, overall then, are there specific commodities or assets that you personally feel a little bit more bullish on right now, even with the prices at where they are?
I think, look, the way I would sum it up is, to me, I've always dealt with people who are, permanent holders of gold, and therefore, gold is not necessarily a tactical asset. That is a permanent piece of real estate in the portfolio, and therefore the clients that we have that own gold, they've owned gold typically for a long time. They may add to gold, they may take away, but they never fully sell it. And I think the story is interesting. We're getting people into silver, and platinum is the one that our platinum ETF has seen a huge amount of interest as PLTM over the last few months. That's the one that I think is not on people's radar because they probably don't know or not familiar with platinum as much. And then we have COMB, which is our diversified commodity ETF. And I think, again, if you're looking for a asset class in this environment that's, dare I say, undervalued, commodities as a whole, one of those compared to most other things. And so we're seeing a lot of renewed interest in people just looking to diversify into a commodity allocation. It might be 5-10% of the portfolio, something like that.
Well, where else can we find your work? What can we find you overall?
Yeah, GraniteShares.com is the main website. And then we're active on X at GraniteShares on X, or at Will Rhind, myself, on LinkedIn, other social media sites.
We'll put the links down below, so make sure to follow GraniteShares and Will down there. So thank you again, Will. Take care for now. We'll speak again soon.
Thanks, David. Always a pleasure.
Thank you for watching. Don't forget to like and subscribe.